So ladies and gents, good morning, and again a very warm welcome to this morning's webinar entitled National Insurance, What You Need to Know in 2022, hosted by AVC Wise. Let me introduce myself so you know who I am. My name is Greg March and I'm one of the Retirement Educational Specialists for AVC Wise, and I've got the pleasure of taking you for the webinar, which will probably last for about half an hour or so. Just before we get into the information about the webinar itself, please be aware that it's based upon the current tax year, so the tax year that starts on the 6th of April, so it's based upon the current rules. And any information that we give you today should not be taken as regulated financial advice. It's purely for information purposes only. So what are we going to do today? Well, we're going to talk about national insurance and, more importantly, the changes to national insurance and what you can do to potentially offset those tax increases. So the first thing we're going to do is explain what national insurance is. Well, national insurance is just another form of taxation that both you and I pay, and we pay it through our salary on any earned income that we receive above a certain allowance. National insurance, the reason that it's separate from income tax is the government likes to keep national insurance separate because this is supposed to pay for things like the state pension, the NHS, and also social care. Who pays national insurance? Well, if you're an employee and you're earning aged over 16 years old and earning in excess of £190 per week, then you pay national insurance. Now, the £190 per week is known as the primary threshold, and that equates to £9,880 currently per annum. So if you've got income above £9,880 per annum, then you and I pay national insurance. Now, be aware that this primary threshold is increasing, and it's increasing on the 5th of July, and I'll explain that in just a few moments' time. And how much do we pay? Well, this is dependent upon your earnings. So anything above the £190 per week, you pay national insurance. And the current rate of national insurance, if you're a basic rate taxpayer, and that means you have income below £50,270, the current rate of national insurance is 13.25%. If you're a high rate taxpayer and have any income above £50,270, then you pay national insurance on the income above that at a rate of 3.25%. So this is in addition to the tax that we pay, which as a basic rate taxpayer will be 20%, and as a higher rate taxpayer will be 40%. So when somebody says to you how much tax you pay from your salary, then the simple answer is, as a basic rate taxpayer, it's approximately 33.25%. If you're a higher rate taxpayer, it's 43.25%. So anything that you and I can do to avoid these taxes legally in the right fashion, then will be beneficial for us going forward. Now, we mentioned that the national insurance goes towards the state pension. So what I'd like to do is give you an overview of how the state pension works. Now, the state pension has been through quite a few changes in recent years. In fact, the state pension was introduced by Clement Attlee, the Prime Minister at the time, in 1948. And between 1948 and 2016, you had the ability to pay into the state pension, but you also had the ability to pay slightly more national insurance and pay what we call SERBs, which is earnings-related pensions, and also the state second pension. So you had the ability to pay more national insurance to get slightly extra pension. You also had the option between 1948 and 2016 not to make those extra payments, and this was known as being contracted out of the state second pension or SERBs. And that's important for you working for the local government, because that will have an impact upon how much state pension potentially you're going to receive. Now, the government thought that the state pension, with all these abilities to pay slightly more, was quite confusing. So in 2016, the government stopped the original state pension, which is now referred to as the old state pension, and they introduced a brand new pension, which is now referred to as the new state pension. And the new state pension's been in existence from 2016, and that's where you and I are now building up pension for when we get to our state retirement age. So how does the new state pension work? Well, quite simply, to access the new state pension, we have to pay national insurance and receive what is known as a qualifying year. Now, to benefit from a qualifying year, what we have to ensure is that we have earnings in excess of what is known as the lower earnings limit. Now, the lower earnings limit is £6,396. £6,396. So if you've got income in excess of that, you will then build up what is known as a qualifying year. Now, to get access to the new state pension, one of the rules now states is that you must have a minimum of 10 qualifying years to benefit from the new state pension. So for whatever reason, if you don't have 10 qualifying years, under your belt when you get to your state pension age, then you're not entitled to the new state pension. But if you have more than 10 qualifying years when you get to the state pension age, then you'll have access to the new state pension. Now remember, the lower earnings limit of £6,396, that's below the primary threshold, which means that you're not actually physically paying any national insurance at this base, but your employer is on your behalf. So the 6,396 is where your employer pays national insurance, but you benefit from a qualifying year. But when your income exceeds the primary threshold, which is 9,880, you also pay national insurance. Now, to get access to the full new state pension, the government states at the point in which you get to your normal pension age, so that could be 66, 67, 68, or whenever, you need to have a minimum of 35 qualifying years. To access the full state pension, you need to have a minimum of 35 qualifying years. Now, the reason it's a minimum of 35 qualifying years is that between 1978 and 2016, if you were a member of the local government pension scheme, you were contracted out of that state second pension. So what this simply means is that during the period between 1978 and 2016, you were paying slightly reduced national insurance because you didn't want to benefit from the state second pension. So that contracting out will have an impact on how many years you'll need to get the full state pension. So what I'd recommend that you do in relationship to the state pension is go onto the government's website and check what your entitlement is. So for some of you, if you've joined the local government after 2016, you would not have contracted out. So therefore, 35 years is what you require to get the full state pension. But for those of you who got service before 2016, it's worthwhile just checking the government's account to see how many years you're going to need. And it might well mean that you need 36, 37, 38 years to get the full state pension. So the website you might want to jot down is www.gov.uk/check-state-pension. So gov.uk/check-state-pension. When you register for this site, a personal account will appear. So it will say Bob, if that's your name, your record state that you will need, and then it will tell you how many years you need to get the full state pension. Now, if you can't work those extra years, you do have the ability to buy back years from the government, and that's generally 6 years prior to your state pension age. So if you can't work those extra years because you're too close to your retirement date today, you can buy back state pension, and you go online and it'll explain how much that will cost you. Another thing that you need to be aware of with the state pension as well is a lot of people believe that when they get to their normal pension age or the state pension age, the government just presses a button and pays you the state pension. That's not the case. You have to physically apply for the state pension for it to be paid. So roughly 3 to 4 months before your state pension age, again, go online, go onto the website, the government's website, and apply for your state pension. So that's something, again, you might want to just jot down that you need to apply for the state pension to be paid. So just a couple of the things I want to talk to you about regarding national insurance. So the level of national insurance you pay does not define how much state pension that you're going to receive. Because remember, all you need to do to receive a qualifying year is earn in excess of £6,396 in the current year. That's all you need to do. So if somebody's earning, let's say, 40,000 and somebody's earning 140,000, they still get the same qualifying year. So how much you pay when it comes to national insurance does not impact how much you receive when it comes to the state pension. So therefore, if you were to make a contribution to the Shared Cost AVC, then this does not damage your state pension. So when you make a contribution to a Shared Cost AVC, which I'm going to explain in just a few moments, this does not damage your state pension. However, there are some local government that do allow you to pay so much into the Shared Cost AVC that you could potentially fall below what we call the lower earnings limit. So if you do make a contribution and your employer allows you to make a contribution to such an extent that your salary falls below the £6,396, then this could potentially damage your state pension. So all I would say to you is if you're making a major contribution to the Shared Cost AVC, I would probably just get myself a one-to-one to confirm that it's not allowing you to fall below the lower earnings limit. And I'll explain how you do that, and again, in a few moments' time. So just to consolidate this part of the presentation, the state pension, all you need to do is earn in excess of the lower earnings limit, which is 6,396. It doesn't matter how much you earn, you'll benefit from a qualifying year. By making contributions towards the salary sacrifice share cost AVC, for the majority of you, this will not impact any state pension benefits. Now, in recent months or recent weeks, you've probably seen the headlines throughout the broad papers that national insurance contributions are increasing, that the government's increasing the threshold as well when it comes to national insurance. All these different headlines can get quite confusing. So what I'd like to do is I'd like to explain what you need to know about the increases to national insurance. So you can read the headlines, but let me explain, hopefully in a simple manner, what you need to know. On the 6th of April this year, national insurance increased, and it went from 12% as a basic rate taxpayer to 13.25%. So there's a 1.25% increase. If you're a high rate taxpayer on any income in excess of 50,270, that used to be 2% national insurance, but now it's 3.25%. So national insurance has increased. Now, what does that mean to the majority of the people in the audience today? Well, unfortunately, what this means is that unless you put some plans in place, is that you will be paying more national insurance, ultimately more tax. The reason for that, the Office of Fiscal Studies stated that anyone who has a salary in excess of 25,000 will be potentially worse off. And if you look at checkersalary.co.uk that looks at the average salaries for our different sectors, they state that the average salary for the local government is in excess of 26,400. So the majority of people potentially will be paying more national insurance unless you plan. And to confuse matters even further, when the government increased the rate by 1.25%, they said this is going to be to fund social care. And they needed this to fund that social care aspect. But then in the spring statement, the Chancellor made another announcement in relationship to national insurance, and they stated this: the current primary threshold, so this is the amount of money that we need to earn before we pay national insurance, of £9,880, will increase. And it's going to increase on the 5th of July to 12,570. So it's all a little bit confusing with what the government's actually trying to achieve with this increase in national insurance. So what this means is that the primary threshold is now being brought in line with the level or our personal allowance when it comes to taxation. So with taxation, if you have income in excess of 12,570, you start paying tax at a rate of 20%. The national insurance threshold will increase that level from the 5th of July. So this is going to get a little bit messy for all of us to understand truly the impact of national insurance increases. So what I'd recommend that we all do is, rather than wait to find out what the impact is going to be by another form of tax, why not put some plans in place? And we can plan to avoid the hike with national insurance. And the reason for that is that we have access to, or shall I say you have access to, via your employer, the salary sacrifice share cost AVC. And as you're all probably aware, with the salary sacrifice share cost AVC, you have a vehicle that allows you to benefit from not only national insurance savings, but tax savings as well. So let me kind of recap on how this works. So the salary sacrifice share cost AVC is an additional mechanism for you to save towards retirement, in addition to your contribution to the local government pension scheme. It's a separate pension pot. But this pension pot, when you make a contribution, you'll benefit from tax relief, which means if you're a basic rate taxpayer and you pay the government tax at the rate of 20%, the government will put 20% extra relief into the pension pot on your behalf. But they'll also put national insurance relief in as well. So when the government is increasing national insurance for the majority, you have a vehicle which will give you national insurance relief when you save for your own retirement. So on one hand, you have the option to do nothing and pay this money to the government. But on the other hand, you have the option to plan for your own retirement and pay this money to yourself for when you do retire. So any contribution towards the salary sacrifice share cost AVC will benefit from tax relief at a rate of 20% or 40%, and that national insurance relief that's just increased, so it's a rate of 13.25 or a rate of 3.25 if you're a high rate taxpayer. So it's a perfect opportunity for all of you to benefit from a double tax break, and also build up a pot of funds that will become available for you at the point in which you decide to retire. And as you're probably aware, one of the key benefits of the Shared Cost AVC in conjunction with the local government pension scheme is that when you get to the point in which you draw your pension from the local authority, you have the ability, if you so desire, to draw the Shared Cost AVC at the same time. And as long as the cash equivalent value of both pots doesn't exceed 25%, then all of the Shared Cost AVC, with all of those tax benefits, can be given back to you as a tax-free lump sum. So it's the best of both worlds. You're saving on the tax increases today, and also you're benefiting from the ability to access this as a tax-free lump sum at the point in which you retire, without having to reduce that fantastic local government pension scheme that you've also got access to as well. And the other benefit for a lot of people that you're not truly aware of is the flexibility that this scheme offers. And what I mean by that is this, is that when you set a contract with a pension, most people think that that contract has to stay at the same level. So the amount that we pay has to stay at the same level each month. But with the salary sacrifice Shared Cost AVC, it doesn't. You have the ability to amend your contribution every single month if you so desire. So you could establish a contract today. You think, well, I've got this national insurance hike. I'd like to save on that. I'm going to increase my AVC. I'm going to set up an AVC. And let's say I'll just do £100 per month. You may find that next month you can afford a little bit more, so you can increase it. You may find, though, the following month that because of things like your boiler going or your MOT that's due, you have the ability to decrease it. So one of the real benefits of the salary sacrifice Shared Cost AVC is you will be saving on tax, you will be saving on national insurance and therefore reducing the impact of the tax hikes that the government's throwing out, and you have the flexibility to change your contribution at any given stage. So it's a win-win for all of you in reality. So how does it work? So as you're probably well aware, with the salary sacrifice Shared Cost AVC, you decide to invest on a monthly basis. You set what contribution that you think is right for yourself. That contribution goes into your Shared Cost AVC, and that's through the provider that's been set up by your council. So that could be Prudential, Standard Life, Legal and General, or Clerical Medical. You've got the flexibility on the way in, as we've just mentioned, so you can change your contributions as and when it suits you. There are investment choices for everyone. So if you see yourself as a high-risk investor where you're looking for the high potential for returns, then there are funds there for you. If you see yourself at the other end of the spectrum where you're a very low-risk investor and all you want to benefit from is the tax and national insurance savings, there are minimal risk funds for you and anything in between. And then you've got the flexibility on the way out. And what I mean by that is the majority of people will use a salary sacrifice Shared Cost AVC as a way of building up a tax-free lump sum. But if that's not right for you, well, you can use this to generate further income. So you can use it to generate income by buying extra pension from the local government or buying extra pension through the open market. So you've got flexibility on all areas of the Shared Cost AVC. But remember, with a little bit of planning today, you'll be saving on that national insurance hike that the government's introduced. So it's a win-win for the majority of us. Now, if you go online to the AVC Wise calculator or the AVC Wise website, there is a calculator that's available for all of us to look at. And if you look at this calculator, you can actually mess around with your contribution. So all you need to do is populate the calculator. So if you're in Scotland, then click on the Scotland tab, England, Northern Ireland or Wales. Enter your salary, enter your tax code, then enter the gross contribution. Now, the gross contribution is what actually goes into the Shared Cost AVC. But what you'll see on the screen is we've got a gross contribution of £250. But on the right-hand side, it says the net cost from your monthly take-home pay will be £167. So what this is showing you is that if you were to make a gross contribution to the Shared Cost AVC from your pocket, so from your wallet or your purse, it's only going to cost you £167. Let's just think about that. We put £167 on the table today for retirement, and we look at it and straight away it's worth £250. The reason for that is that tax and national insurance relief that you're all receiving. Now, when you do your application or if you amend your application, just be aware you need to enter the gross figure. So in this example, the £250, but remember that will only cost you, if you're a basic rate taxpayer, £167. And at the bottom of the calculator, you can see there's a year icon. You can change that. So if you've got a year to run or you've got 30 years to run before you retire, just change the number of years and then it will tell you what your potential is. Now, in the dark blue box, this is showing you what the possible returns could be at the point in which you retire. Now, this is based upon what we call a net growth of 3%. So that means the AVC fund that you choose has a growth of 3% after charges, and the charges are applied by your AVC provider. So what this is showing you is if you did invest £250 per month for the next 15 years, then at the point in which you retire, potentially you can pick up just under £57,000, and that could be as a tax-free lump sum. But that £57,000 has only cost you £30,000 over the 15 years. So it's a fantastic way of you saving, not only for retirement, but also saving on tax and national insurance today. So £167 from your pocket instantly is worth £250 for your retirement. So if you can afford just a little bit, it's a worthwhile avenue to look at. Now, we are aware that some of you will find pensions quite confusing, and pensions, let's be honest, can be quite confusing. So we do offer you the ability to have a 20-minute team call, a team meeting. And during that 20-minute team meeting, what myself and our colleagues can do is we can assist you in your overall plan, so we can calculate the maximum AVC allowable as a tax-free lump sum. So this is the maximum you can take out as a tax-free lump sum. So we'll need to know things about your pension. We'll also look at the maximum you can calculate so you don't fall below what we call the national minimum wage. And then we can tailor this call to you, so to work out exactly what you're trying to achieve. Please be aware, though, at the call, we cannot give you regulated financial advice, so it's on the same basis as of today. It's educational purposes only. Now, for you to be prepared for that call, what we would ask you to do is get a copy of your local government pension scheme, but projected to your chosen retirement date. So if you've got a normal pension age of 67, but you think, do you know what, I'd like to retire at 64, please get the pension projection to 64. It may mean that you need to go online or speak to your pension department, but just get that pension projection to 64. If you've got an existing AVC with one of your providers, let's say the Prudential, then get yourself an up-to-date valuation of that and bring that to the meeting as well. And also have a pay slip to hand. Now, the reason that we need your pay slip is we need to know what your gross salary is and also what your tax code is. So a little bit of preparation before, if you don't mind, then we'll ensure that the meeting for you goes as smoothly as it possibly can. And then you'll benefit. Once you understand it a little bit more, you'll start benefiting and building up a pot that you can then use to fund and hopefully improve your retirement lifestyle. It's never too late to start, and it's never too early. Now, there are some considerations you need to be aware of when it comes to the salary sacrifice Shared Cost AVC. For you to access that, you have to be an active member of the local government pension scheme. So you need to be an active member of the local government pension scheme, and also in reality, you need to be a taxpayer. When we look at the calculations, remember we've got the national minimum wage, which you've touched upon already, so we can't put too much in that we fall below that, but checks will be done. And also we need to ensure that checks are done as well to ensure you don't fall below the lower earnings limit. So that's the level in which you need to receive as income before you start building up state pension. So we need to ensure that that doesn't happen. So there will be checks done by your employer. But remember, there are one or two employers that do allow you to invest so much that you do go below that level. So if you're going to put large contributions in, please get yourself a one-to-one. Other allowances you need to be aware of, there is something called the annual allowance. So this is the amount of money in which we can put away to pensions on an annual basis and still benefit from tax relief. And that's currently set at £40,000. And you're using a proportion of that just by being a member of the local government pension scheme. We've got the lifetime allowance. Now, this is the amount of money that we can have in pensions at the point in which we retire, the cash equivalent value. And currently that cannot exceed more than £1,073,100. And that includes every pension you've got access to, excluding the state pension. Now, a lot of people might think that's a really high level, but if you've been in the local authority for a while and you're on a decent salary with a decent pension, then you could be quite close. And then the only other allowance that may or may not be a concern is if you've taken a defined contribution scheme, a pension, personal pension scheme in a flexible manner, then you may have triggered something called the money purchase annual allowance. And this is where the government restricts what you can put into pensions going forward from £40,000 to £4,000, where you benefit from tax relief. But if you trigger that, then your pension provider would have informed you. So if you haven't taken any pensions, don't worry about that. But if you have triggered it, your pension provider would have informed you. And remember, when you're considering your affordability, you have the ability to change this on a monthly basis. So the more you put in, potentially the more you get out. So if you can stretch yourself just a little bit, because ultimately you've got the option of paying these taxes to the government, or you pay the taxes to your own pot for your own retirement. So if you can stretch yourself a little bit, then that's great. But if affordability does change tomorrow, you can always drop your premium down. And the minimum premium that you can actually have in the scheme is £2 per month. So it's affordable for us all. So that ability to change your contribution, just keep that at the back of your mind when setting up your levels. And if you do leave your employer and therefore come out of the local government pension scheme, then these benefits will freeze, and then they'll be waiting for you when you draw your benefits at a later stage. So if you do leave your employer, you can't continue to pay into the scheme. The benefits will freeze, but they'll be waiting for you at the point in which you draw your other schemes. So how do we apply? Well, if you're new to Shared Cost AVCs, go onto the AVC Wise website, and we'll send you to the landing page when we finish the webinar today. But it's avcwise.co.uk. Just click on New, enter your details, what investment funds you'd like to choose, and then your employer will then verify your application. And once that's done, they will then set you up with the provider, and then your contribution will take form from the next available payroll. So the sooner you do things like this, the better it's going to be for yourself. Now, if you're already a member of the Shared Cost AVC and you'd like to maybe increase or decrease your contribution, again, go onto your account and just click on amend, and it's as simple as that. So once you amend your contribution, it will then take place from the next available payroll. And that's a really useful tool to have. And then finally, just before I go to Nick, if you've got any questions, let's just explain how you can contact us. So if you do want to benefit from a one-to-one, the Teams call, then simply send us an email at support@avcwise.co.uk. If you want to contact us in any other way, then you've got live chat that's available on the website. And also we've got the old-fashioned telephone. Just pick up the phone and give us a call. And if you want to ask questions, but you don't want to ask the questions today, then again on our website, we've got the frequently asked questions section. So we put all the questions we get into there. And there's also a knowledge hub as well, where you can access some of those calculators. So hopefully you found the session of use. So what I'm now going to do is just pass you over to Nick and ask Nick if you've had any questions. So Nick.
Hello, Greg. Yes, we had some questions come in. So let's have a look at these now. So David's asked, how much would state pension provide if you've only managed a maximum 10-year qualifying years pension prior to getting to state pension age? Any idea? Well, David, I mean, in terms of how you'd perhaps work that out, is you would take this kind of standard amount that you're due if you've got full qualifying years in with the state pension, and you would divide it by 35 and then times it by 10 to give you perhaps an approximate idea as to how much your state pension would be with 10 years qualifying service. So you'd be just looking to find out what the full state pension amount would be, divided by 35 and then timesing it by 10 to give you an approximate idea on what you might get.
I'd also add to that, Nick, as well. Yeah. Just go on the website. So go onto the government's website and it'll all be there for you.
That's absolutely true, Greg. Yeah. So that's the www.gov.uk/check-state-pension. Yes, have a look on that website because it should tell you the information you're looking for there. Diane's asked, does the .gov site tell me when I've paid enough to make the equivalent of 35 years, i.e. I don't want to work until I'm 67. I had years off when I was young. I've contracted out, so it'd be difficult for me to calculate the years I have. So yes, from what I understand, the website that I've just mentioned there, the .gov.uk check state pension website that I mentioned, that should tell you exactly how much level of service you've built up within the state pension. And you should be able to check how many years you've got, qualifying years you've got within that website. So I would definitely have a look on there because it should give you the information you're looking for. Debbie's asked, I paid towards an AVC. Is this deducted before or after NI is taken off? It would take me below £12,570. Well, when you pay into an AVC, it's taken before any tax or national insurance is taken, because the money that you're putting into the AVC is going into the arrangement free of any tax deduction or national insurance deduction. Now, if you're paying enough into your AVC that is taking your salary below £12,570, and remember that that's the upper threshold in relation to July. At the moment, it's not that figure, it's £9,880 as it stands at the moment. But yes, if you get to July and you're paying enough into your AVC that you're actually reducing your salary below that £12,570 level, that's when you wouldn't, in theory, be benefiting from national insurance savings below that rate. So you may want to consider, if you wanted to try and pay an amount into the AVC that is tax and national insurance efficient, you may want to either have a chat with us to see, what you can pay in and actually relieve yourself of tax and national insurance, because as you rightly say that, if you're paying an amount in at the moment that's going to take you below that 12,570, when we get to July, it would be that on a proportion of it, you may not be getting any national insurance savings. Elaine has asked, national insurance categories. Category B, would this mean only getting a reduced state pension? From what I understand, Elaine, Category B is where you are paying reduced national insurance contributions, and I think that can result in you having a reduced state pension in those circumstances. Would you happen to know anything about that, Greg, in terms of Category B?
No, again, as long my understanding, as long as you've got your income above your 6396. But what I would do is, if you do go to the government's website, there is an ability there to ask questions. Okay. So again, just put it into the government's website, and then you'll get an answer on that one, Elaine.
Okay,
safe and sorry.
Absolutely. Bruce has asked, what was the cash pot 25% of AVC and pension? Okay, Bruce, well, what Greg was referring to there is the fact is you can save an amount in your AVC and potentially take it all back as a tax-free cash lump sum when you take your AVC at the same time as you take your main local government pension. But there is always an upper limit to that, and that upper limit is essentially means that you can't, as long as your AVC pot isn't worth more than 25% of the total value of your LGPS benefits, then you can take it all back tax-free. And the way that's worked out is you would take the annual pension that you're expecting to receive from your main local government pension, you would times that annual pension figure by a factor of 20. You would then add on to that figure your AVC pot value. And also, if you've been in the 80th local government pension scheme, which ran up to 2008, you would also be entitled to an automatic tax-free cash from the main scheme, which you would need to add into that total figure as well. And if you've got that total figure and divide it by 4 to give you the 25%, as long as your AVC and automatic tax-free cash, if you're due automatic tax-free cash, that is within that 25% figure, then you can take the whole AVC all back tax-free. So it's quite a lot of information to take in. I would say if you're looking to find out, what your upper limit would be, it might be best booking a meeting with us by sending us an email to support@avcwise.co.uk, and we can have a look at that for you. Fiona's asked, if I carry on working after state retirement age and draw my state pension, can I still pay into a shared cost AVC? Yes, that's fine, Fiona. I mean, the stipulation on the AVC is that you have to be making contributions into your main local government pension scheme. So, you can draw on your state pension, that's fine. As long as you're paying into your main local government pension scheme with your employer, then yes, you still be able to make contributions into the shared cost AVC. John said, I've been paying into my salary sacrifice AVC since its introduction way back. I was told that it was established before the rules changed, and that at retirement we would be able to draw out 100% of the value of the pot tax-free, irrespective of the 25% total pension pot threshold. But the SS AVC had to be in place before the cutoff date change. Are you now saying that's not the case? Okay, well, I don't know if you're referring to, John, in 2014, back in 2014, the local government pension schemes were actually saying that with the AVC arrangement that was coming into place from April 2014, that actually people would perhaps lose the possibility of being able to take the whole AVC all back as a tax-free cash lump sum. That was their intention. And that's why there was a big rush just before April 2014 for people to open up AVC arrangements. Now, what actually transpired is about a year further down the line, the local government pension schemes or pension funds actually retracted that decision and said that actually anyone that had joined the local government AVC since April 2014 would be able to do exactly the same as anyone that had joined prior to April 2014, in that you can take the whole AVC all back as tax-free cash. You've still got that upper limit in place where as I've mentioned a moment or so back, you can, with the AVC, you can build up a pot of money, and as long as it's within 25% of the capital value of your LGPS benefits, you can take it all back tax-free. That's still in place. That was in place prior to 2014 and after 2014. Nothing's changed in that respect. But yes, you can still potentially take the whole AVC pot all back tax-free cash as a lump sum within limits. Bruce has asked, what dates do you need to know to make changes, payroll dates or AVC dates? Well, I mean, you don't need to know any dates to make changes to your AVC, Bruce. You just need to log into your AVC Wise account and click on amend contribution. If you're looking to find out, when it will take effect from, every organization has its own different cutoff dates for when an application or amendment application needs to be received and be processed by payroll. So if you're looking to find those out, it might be worth just giving us a call. Because we should be able to tell you exactly what the cutoff dates are for your particular organization. But you don't, in theory, need to know those dates. As soon as you make the amendment request on our website, that will go through to your payroll, and they will then typically introduce the deduction from the following month. We've had some more questions come in as well. So we've got one here from Joy. I wish to access a deferred local authority pension next year. Does this mean that I cannot pay more than £4,000 into an AVC going forward? Joy, well, if you're talking about a local government pension scheme, which I think you are, then actually you're not going to trigger that money purchase annual allowance that Greg talked about a moment or so back. You only trigger that money purchase annual allowance on what we call defined contribution pensions. And that's potentially, if you're accessing one of those, where you may trigger the money purchase annual allowance. If you're accessing a deferred local government pension in the standard way, and you're not transferring it out or anything like that to another provider, then you're not going to trigger that money purchase annual allowance, and which is £4,000 currently. So there shouldn't be an issue there if it is a local government pension scheme. Deborah has said the new state pension change in 2016, where say need 10 years to qualify for that, is that 10 years after 2016 to work till 2026 or at least, or just 10 years minimum over career? Deborah, I think that, I think I know what you're referring to there. I mean, essentially the change came in 2016, but actually, they're looking over your full working life to determine what years you've built up for the state pension. So no, you just because it started in 2000, or the change came in 2016, doesn't mean you have to work to 2026 to get 10 years. They'll be looking at your full working history and what you've paid in national insurance over that period of time that you've been working. James has said the state pension calculator says I haven't paid for 8 years since 1999 to 2008. It won't allow me to buy back more than the past missed 2 years. Any ideas why this is? Periods before 2006 not available to me. I'm not entirely sure on that, James. As far as I was aware, you could buy service back in the state pension. But
what happens on that one is the government only allows you to go back 6 years, and then it's the unused allowances in those 6 years. So that's where it could be, just from the principle that you may have got some used allowances during that time. But again, that could be another one just to put into that email when you go on the government's website. So they'll only let you look back 6 years at any given stage.
Okay, that makes sense. I'm glad. Thank you for that. And Eric's just mentioned exactly the same thing as James has mentioned there. Said I've got a similar response as James, so I have said I can't buy the extra years. So as Greg's mentioned there, they allow you to go back 6 years. So that may be the issue there. But it's worth going onto the website and sending an email directly to the state pension to find out exactly what is going on in that respect. But yeah, it could well be that you're blocked from kind of buying more years if they're only looking back into the previous 6 years for buying additional years in the state pension. Okay, I think that's all the questions so far then, Greg.
That's brilliant. Thank you very much, Nick, for your responses there. So yeah, when you go onto that government's website and you set up an account for yourself, there is the ability to email them. And they are actually quite good. And they're not good at answering the phone, but they are quite good at coming back to you with the email. So if you've got any questions on a specific basis, like I can't buy the national insurance that I require, send them an email and they'll tell you what the best approach is going to be going forward. So hopefully you found today's presentation of use. And remember, you've got a choice. One of those choices is we can just allow these taxes to increase and have an impact upon our lifestyle, or we can put some plans in place and save a bit of tax going forward, which we'll ultimately benefit from at the point in which we retire. And it's up to you what you decide to do. But with a little bit of planning today, you can actually get more benefit going into the salary sacrifice share cost AVC. So hopefully you found today's webinar of use. Thank you very much for your time and attention today. And hopefully we'll speak again soon. Thank you very much and goodbye.